There are real estate strategies that work in any type of market conditions and any type of economy. And yeah, that does include today, even though we are in a very unusual and sometimes confusing time. The trick, though, is that you have to continuously update the tactics and strategies that you're using to adapt to current market conditions. You can't just take things that were working in 2010 or 2015 or 2020 and apply them to today's investing climate. You have to continuously evaluate which ones are best for you, given your time horizon, your risk tolerance, the experience that you have, and the resources that you can bring to bear in your portfolio, like how much time you can invest and how much money. In today's video, I'm going to give you my personal rankings for which strategies I think are best for me, given my experience, risk tolerance, and all that. And at the end of the video, I'm also going to share with you how you can do this evaluation for yourself. Hey everyone, this is Dave Meyer with BiggerPockets. If you don't know me, I've been an investor for over 15 years, and talking about real estate strategy is one of my favorite things. And I know this can be sort of frustrating to people that there's no one-size-fits-all approach to strategy, but once you realize and learn how to sort of apply some strategic principles to your own portfolio, I promise you, you're going to get further in your investing career and you're going to get a lot closer to your financial goals. So for our video today, I've put together a virtual whiteboard, and you can see that I've created a graph here with risk on the vertical axis and reward on the horizontal axis. And I like doing this when I rank strategies because, as I was saying, it is a subjective decision. There's no one strategy that's right for everyone. It really largely depends on how much risk you want to take on in your portfolio. So I'm going to start by placing each of these different strategies that you see here on the right on this graph. And I'm going to start with the one that is the lowest risk, lowest reward. That is bonds. These are US Treasuries. This is basically lending money to the US government. And to date, the US government has never defaulted on its loans. So the risk is very low. But right now, if you were going to get a 10-year US Treasury, for example, the yield on that is about 4.3%, which is pretty solid, especially in recent history. So I would put this somewhere along here. I would say that it's very low risk. Of course, there is still a chance that the US government defaults on its loans, but it's pretty unlikely. And there is still a decent reward. 4% is not going to do as well as most real estate strategies, but given the risk reward spectrum, it's pretty good. And I should note that as you look at this chart, anything that falls below the line is what I personally believe to have better reward than risk. Anything that's right on the line has about an appropriate or historical average for risk reward. And anything above that line is going to be something I personally see as more risky than the reward is worth at this point in time, where we are midway through 2024. So this is where I see bonds. Let's move on to our next strategies here, which are all different types of rental property investing. So we have house hacking, buy and hold, and value add rentals. So for house hacking, I see the risk as relatively low, but the reward is a bit lower than it used to be, in my opinion, because buying a home is so much more expensive than rent right now. I still think there are a lot of intangible benefits of house hacking that are very worthwhile. Like there's great tax benefits. It teaches you how to be a real estate investor really well. There are great tax benefits. You can generate cash flow. You can reduce your cost of living. There's all sorts of good things about house hacking. The only reason it's not better than it is right now in 2024 is I think house hacking is a little bit less desirable than it used to be in really expensive markets. There was a time where I would basically say to anyone that house hacking was a great option for a first investment. Now in super expensive markets like say Seattle or Los Angeles or even Denver where I started, it is a little bit more of a question. Like you may actually be better off renting in those markets and then using your capital to invest in an out-of-state market. It doesn't mean house hacking is not a benefit, but I think it's less of a slam dunk in super expensive markets than it used to be. All right, let's move on to our traditional buy and hold rental properties. I think that these are still pretty good. They're low risk, but I don't think the reward is that high right now. So I'm going to put this around here. If you watch me, I do think that there is a chance that housing prices go down a little bit in the next year or so, but I am not personally too concerned about a crash. So if you're buying and holding for a long period of time, I still think there's going to be solid reward from rental property investing, pretty low risk. The challenge is just finding something that offers positive cash flows. But if you can find it, which is definitely possible, I've bought MLS deals this year. If you can find those can be pretty good on the risk reward spectrum. Next, we'll do value add rentals. And the difference here between this and buy and hold is that you're buying something that's not up to its highest and best use and renovating it. That can be like a full gut rehab. It can be a cosmetic rehab. But I see this as a really good option right now. So I'm going to put it here, around right here. And this is not precise, everyone. I'm just kind of like putting them in the right ballpark. I see this as good reward for the risk right now. Now, this depends on your personality and what your experience is, but I've done rehabs, so the risk for me is a little lower because I know how to manage it. But I think that right now you're seeing that a lot of homes that are not in really good condition are starting to flatten out in price. But homes that are in really good condition are actually still growing. And so that means the margin for doing value add investments is actually growing. And so if you can find a good deal and renovate it, there's a good profit margin to be had. And you'll see that not just with BRRRR and value add rentals, but also with flipping and new construction. So I'm going to put these over here. As you can see, I still think rental property investing is great. That's no surprise. That's what I invest in. I think it's a great long-term way to build wealth. Next, let's turn to some of the other real estate investing strategies. So this orange one here is short-term rentals or mid-term rentals. And I'm going to put it right about here. I think that the risk in short-term rentals right now is, let's put it right here. I think the risk in short-term rentals and mid-term rentals right now is relatively high. That doesn't mean you can't succeed. I know tons of people who are succeeding at it. I'm just saying on average, I think short-term rentals are doing not as well as they were for a while. And I personally see risk in that market. I think there's a lot of regulation coming in. There's an excess of supply. Average revenue per unit has come down since the peak of the pandemic. It's still up over 2019 levels. But to me, there's a lot of question marks in short-term rentals, and I personally am sort of taking a pause on short-term rentals for the time being. Doesn't mean you can't make money in them. Again, this is just my evaluation of risk and reward. I'll show you how to do yours in just a few minutes. Next, we have flipping, which I actually think is still as good an option as really it's always been. I think flipping is really good on the spectrum of risk and reward because it's really up to you what level of renovation you want to take on, how big of a project. But flipping can work really well in markets that are appreciating. As of right now, home prices are up about 5% year over year. And although I think that will soften over the next couple of years, next 6 months, let's say a year, I don't necessarily think prices are going to go down. So if you're a good flipper, still a good risk reward profile. Same thing goes with new construction. I just put that a little bit higher in terms of risk and a little bit higher in terms of reward. You can make huge profits in new construction, but a lot more can go wrong in terms of permitting and time. I actually think new construction in a lot of ways is less risky than flipping because you're building it from scratch. There's not as many unknowns as flipping a house, but getting permits, material costs, labor risk, there's just other things that can go wrong with new construction. And so it's generally considered a more high risk, more high reward proposition. Next, we have lending, which is not something we always talk about in terms of real estate investing strategies, but it's a great one. And I would put it somewhere around here. I think that lending, let's put it right here. It's a great reward right now. I think you can easily earn 8, 10, 12%. I'm going to move it over a little bit. 8, 10, 12% returns, cash returns. And if you do it well, then there doesn't necessarily need to be that much risk. I'm not going to explain all of lending right now, but I do think it has a good risk reward profile in today's environment. And then commercial real estate, I'm going to put this as the highest risk. There are going to be opportunities in commercial real estate, though. There's distress coming, which means that there is going to be risk reward, but I think we're still a little early in the cycle to reduce some of that risk. Prices are still falling, and I think that buying multifamily, buying office space, you can find deals right now, but there's also going to be some real risk for you to consider before jumping into that. So hopefully this makes sense to you. I expect that you're all going to disagree. Let me know in the comments below what you think of your own risk reward profile. This is personally how I see things and how I am evaluating them in terms of deciding where I'm going to put my own money into real estate. Just telling you guys, this year I have bought buy and hold investments, I've bought BRRRR investments, and I've done some lending as well. And I actually will admit I have done one commercial real estate deal, got a screaming deal. There is going to be some more risk in that, but I was willing to take a swing on it because we bought it for like 50% below what it sold for in 2019, even pre-pandemic. So I was willing to take the risk on that, but I understand that there is risk in that deal. I'm willing to do that because I think there's huge upside. Now, if you want to do this type of evaluation for yourself, I recommend that you start by setting your own goals, figuring out your own risk tolerance. And that can be easier said than done if you don't have a framework. And so what I've done is actually wrote an entire book and planner on how to do this. It's called the Real Estate Strategy Planner. You can check it out right here. And in it is filled with different exercises that you can use to figure out your own risk tolerance, set your own goals, figure out the right markets, right strategies, and right tactics for you. If you want to buy that, we will put a link in the description below. If not, you can feel free to try and just draw this on a whiteboard, like the thing that I just created here. You could just do this on a whiteboard and do this evaluation for yourself to figure out where you're going to allocate your time and money in the coming year. I thank you all so much for listening. Again, my name is Dave Meyer for BiggerPockets. If you have any questions about this for me, about strategy in general, you can always hit me up on the BiggerPockets platform or on Instagram, where I'm at the Data Deli. Thanks again. I'll see you next time.